Hey, what's going on, guys? So on today's episode, we're going to talk about merger arbitrage. And for those of you guys who aren't all too familiar with the topic, it's essentially where a company decides and announces that it's going to acquire another company whole at some specified price. Yet for some reasons, maybe risks that are embedded or involved with that particular transaction, the market price of the acquiree or the target company doesn't adjust accordingly to the specified takeout price. And so therefore it kind of opens up a profit potential that certain investors can realize if that transaction goes through and is completed. So what do I mean? Let me just give you a quick example. So let's imagine that there's a company called ABC and it decides that it wants to buy out company XYZ for $100 per share. Now, subsequent to that announcement, the price of XYZ, the acquiree or the target company, trades for about $90 per share, thereby kind of opening up a $10 profit potential for investors. That's essentially kind of how a merger arbitrage opportunity can open up for event-driven investors. So quick note though, the profits of this kind of scenario is never assured or guaranteed, largely due to the fact that whenever a company makes this kind of merger announcement, it's never set in stone. The merger or acquisition can be canceled for a variety of reasons, perhaps competitive reasons. The federal government steps in and says, okay, this is anti-competitive for the particular industry in which these companies operate in, or financing doesn't get executed, or any reason really that could kind of thwart the completion of this particular opportunity. And so what kind of happens in the aftermath is the price for the target company will adjust accordingly once news comes out that the acquisition is not going to go through. So kind of piggybacking off of that example that I was just talking about regarding company ABC and XYZ, let's just hypothetically assume that prior to the acquisition announcement, that XYZ was trading at roughly around $60 per share. Post announcement of the merger, the stock price goes to $90 per share, and then subsequently, after the disclosures have been made public that okay, this merger is not going to go through, the stock price for XYZ will adjust down back to $60 per share. Oftentimes that adjustment or that reversal back to previous price levels oftentimes does occur. And so when you're looking at merger arbitrage opportunities, it could be a pretty high risk, relatively lower reward kind of play or investment opportunity. So in this instance, investors could have won $10 in profits, whereas they're facing down the potential losses of $30 per share. So it's certainly a risky kind of opportunity to consider and to move forward with. Now, with that being said though, the reason why I'm talking about this particular subject matter today on this episode is because I think I came across a very unique situation where when I look at all of the scenarios that could possibly unfold involving this particular acquisition candidate, it seems like the investor is still winning whether the merger goes through, is delayed, or never materializes. And so I just kind of wanted to talk about that and bring this to your attention. So the company is called LSC Communication, ticker symbol LKSD. So the way I'm going to structure this conversation though is I am going to talk about the parties involved, who's the acquiree, who's the acquirer, and then I'm going to move into the thesis behind this particular opportunity. What are the terms of the merger? What's the upside potential? And how do I execute the trade? And then lastly, I want to talk about some of the risks that an interested investor could likely face if you were to pursue this particular opportunity. So without further ado, let's go ahead and start unpacking this particular idea. Okay, so let's start this conversation off with the concerned parties. So the acquirer, or the company that's going to outright purchase the LSC Communications, is Quad Graphics Inc., ticker symbol QUAD. And the acquiree, or the target company, as I said, is LSC Communication, ticker symbol LKSD. So LKSD, it's a traditional and digital print company that kind of caters its offering towards retail companies, and it also sells various office products. Quad is also a competitor of LKSD's, but in addition to traditional print, it also offers, or is trying to reinvent itself in being able to offer a whole suite of marketing solutions for clients. So think marketing development, and then marketing management services, in addition to various logistic services that the company offers. So that's just kind of a little bit of context on the industry. It's a print industry in which these companies operate in, and that's kind of some context on those respective businesses. Okay, so moving on to the terms of the merger agreement. The merger agreement was announced last October 30th, 2018. And at the time of the announcement, just a few details regarding these, the anticipated merger. It's anticipated to close by mid-2019. So as of the day of this recording, think over the next 2 to 4 months. And the transaction is supposed to be effected through an all-stock transaction. And so what that means is, for every one LKSD share out there, it's going to be converted into the right to receive 0.625 Class A quad share, or common stock. So let me repeat that again. So for every one LKSD share, it's going to be converted into the equivalent value of 0.625 Class A quad common stock. So that's the exchange ratio. So for those of you guys who may be thinking, okay, why did you mention Class A? Well, Quad Graphics, it does operate with a dual class structure. And while I don't think this dual class structure is going to be all too relevant for understanding some of the nuances of this transaction, or the gain potential associated with this transaction, just to, for clarification purposes, yes, Quad operates with Class A and Class B common stock. The only difference really is that the Class B common stocks, they are primarily owned by the founding family of Quad Graphics Inc. They have roughly, I believe, 10 voting interests per share, whereas the Class A common stock have only 1 voting interest per share. And the Class B stocks, they don't really trade on the open markets. So again, I don't think it's really all too relevant to our discussion here, but just for clarification purposes for you guys who are kind of scratching your heads, what's going on here with this dual class structure thing. Okay, so concerning the pending merger and some of the conditions that still have to be approved before the merger is finalized, I think insofar as I understand, there's only about one hurdle that remains, and that's regulatory consent from the Justice Department and the Federal Trade Commission. The LKSD shareholders and Quad shareholders have already respectively approved this merger. There's no outside financing that this merger is contingent upon or anything along those lines. It's just that once this regulatory approval does in fact occur, we're kind of off to the races for this transaction being affected. The last bit of information I think that's going to be pertinent for our conversation later on is that, at the time of the announcement, Quad's management team, they did indicate that post-transaction, they anticipate realizing approximately $135 million in net synergies over the next 2 years following the transaction. So I thought that was pretty interesting to consider, and it is going to be relevant to our conversation later on in this episode. Okay, so now on to the upside potential regarding this particular merger arbitrage opportunity. As of the day of this recording, the most recent close on LKSD shares was $7 per share, while Quad's share price was $12.57. If these price levels were to persist up to the date of the merger, LKSD shareholders will receive back $7.86 in Quad equivalent value. How do I get there? You do $12.57, multiplied by 0.625, which is the exchange ratio, which gets you to $7.86. That implies immediate upside through the merger arbitrage of 12.12%. Now, in addition to that, what I didn't mention to you guys is that LKSD, the company, issues a regular quarterly dividend of 26 cents per share. Now, if you were to factor that dividend into the upside potential, you would actually get an incremental 3.7%, which you would have to add to the 12.12%. And that dividend is payable to shareholders on record on May 15th, 2019 of this year. So if you're considering getting involved in this particular opportunity, you actually have unfortunately, a kind of a limited time frame to think about this scenario. You would actually have to execute your order before market close on Monday, May 13th, in order for your transaction to settle to be on record for May 15th. And it takes roughly about 2 business days for your transactions to settle, meaning making you an effective owner to be eligible for that second quarter 2019 dividend of 26 cents per share. So if you were to factor in the 12.2% merger arbitrage upside plus the 3.7% dividend upside, you're looking at a total upside potential within a 2 to 4 month time frame of about 15.9%. 15.9%, you know, big whoop-de-doo, who cares? It's not really like a home run hitter. But if you were to annualize that 15.9%, you're looking at an annualized rate of return closer to 48% to 95%, which is quite a compelling rate of return. Okay, so moving on to how to actually execute this trade, there's a couple ways of going about how to capitalize off of this particular scenario, but I think there's only one real method that's the most prudent and the safest and most advantageous. So traditionally, merger arbitrageurs, what they would do is they would, implement a pair trade. They would conduct a long short. In other words, they would long or purchase LKSD shares while simultaneously shorting Quad shares, thereby kind of ensuring or guaranteeing the return on the pricing discrepancy between where LKSD is trading at versus its implied takeout valuation. Now, there are a few reasons why I'm hesitant or reluctant to execute this kind of trade. And firstly, I don't know what your margin rate is or your cost of shorting. I know what mine is, and it's quite high, so it's very expensive for me to short. So that materially changes the net return potential of this particular opportunity. In addition to that, if you were to implement a short on Quad shares, Quad actually is a dividend issuing company. So in addition to the cost of shorting, you would actually have to pay for the dividend that Quad issues while you're trying to do this pair trade. And then lastly, if in the chance that this merger doesn't actually complete or materialize, what would happen is Quad's valuation would return back up to where it was prior to the merger announcement. So you would actually be losing on the short position. So in addition to the cost of shorting, in addition to the cost of having to pay for the dividend that Quad issues, you would actually also realize a loss from Quad's valuation going back up in the instance that this valuation, or in the instance that this merger doesn't materialize. So this is kind of how your trade could blow up in your face. So it's not the most prudent way, I think, in my view, of going about this particular trade or this scenario. Moving on, if you were to another possible method would be to long LKSD shares while also simultaneously buying put options on Quad shares. It's a similar trade, but at the same time, you're kind of now, again, overcomplicating what could be a far simpler a far simpler transaction for the investor. So when you're buying put options, they could expire absolutely worthless, and that obviously materially changes what the return potential is of this particular scenario. Also, on top of that, you have to decide which put option you want to buy, when is it going to expire, and are the exercise prices advantageous enough for you to be involved. And so again, I think it's kind of overcomplicating what could be a much simpler transaction. And what that much simpler transaction could be is just simply buying or longing LKSD shares. And so if you were to kind of just analyze all of the possible scenarios that could unfold by simply buying LKSD shares, I think the investor walks away with a positive result no matter what the circumstance unfolds. And so I think this is going to be the best or the most advantageous method about capitalizing off of this particular opportunity. So if let's actually go ahead and dive into what these possible scenarios could be. So if the merger actually falls through, doesn't materialize while you're longing LKSD shares, I think it would actually generate a positive result for the shareholder, and largely because after the announcement in October 2018, Quad's valuation started to decline in a very material way. And because LKSD shares are linked to Quad's valuation due to the exchange ratio embedded in the merger acquisition, LKSD shares started to move in tandem with Quad. So when Quad's valuation started to decline, LKSD shares started to decline in step with Quad's valuation. So if you were to remove this merger potential, or this possible merger, I think LKSD shares would revert back to where they were trading out prior to the announcement, which is closer to $10 a share. And so I think it's logical to assume that LKSD shareholders would actually benefit, at least in the short term, if the merger weren't to materialize. And at $10 a share, you're looking at a forward dividend yield of 10%, forward, in my estimation, price to earnings ratio of about 5.7 times, and a forward free cash flow yield of approximately 23%. So that valuation level, it's not ridiculous. It's still, many would view that as a bargain level valuation. So moving on, if you were to run into a scenario where the merger actually gets delayed, LKSD issues a regular quarterly dividend of 26 cents per share. So on an annualized basis, that's a dividend yield of 15%. So just simply sitting on a company where the valuation may not necessarily move up or down, and you're just kind of pocketing 15% dividend yields, that's quite a nice return. I think that's quite a compelling rate of dividend yield. So and then moving on, if the merger does complete, then we go back to the scenario where that I touched upon earlier, where you are going to realize 15.9% within a 2 to 4 month time frame, which translates to an annualized rate of return of 48 to 95%. So whatever the scenario that seems to unfold, simply buying and holding LKSD shares seems to generate a satisfactory result for investors. Now, moving on to the possible risks associated with this particular scenario or particular transaction. This is in my opinion, and it's in my view. So when I say that, I'm trying to emphasize it's just someone else's opinion, and you have to start formulating your own. And so I'm kind of emphasizing the need for you to do your own research. But insofar as I see, and based on my interpretation of the evidence, barring fraud or some act of God, I think the only real risk of owning or longing LKSD shares at current price levels is the possibility that Quad's valuation could decline in a very substantial and meaningful way between now and up to the date of the merger. And whereby, again, like I said, LKSD's valuation is going to move in tandem with Quad's valuation. So if Quad's valuation dips in a very serious way, then LKSD's valuation is going to dip in a meaningful way as well. So if you get involved at current price levels, you could possibly lose on the merger arbitrage if Quad's valuation drops that dramatically. And so to what extent does Quad's valuation have to drop? Well, if you get involved in LKSD at $7 a share, that means in Quad equivalent terms, that $7 a share in LKSD is equivalent to $11.20 in Quad equivalent terms. Now, factoring in also the dividend that you're going to be receiving from LKSD, your actual cost basis is $10.78. How do I get there? Well, you do $7 minus the 26 cents in the dividend, and you get to you have to divide that by the exchange ratio, 0.625. So 7 minus 26 cents divided by 0.625 gets you to your cost basis of $10.78. So as of the day of this recording, the share price of $12.57 has to decline all the way down to $10.78 before you simply just break even on your investment in LKSD shares. Now, let's actually explore that. Let's see what happens if Quad's valuation does in fact dip below $10.78. So that implies your cost basis was $10.78, or let's just say $11.20 was kind of the entry point, right? So what that implies is you're holding on to a post-transaction Quad business at $11.20 per share in Quad equivalent terms. That implies a valuation on pro forma Quad that is going to generate, based on my estimation of what the post-transaction Quad is going to look like, a forward dividend yield of 8.8%, a free cash flow yield of 30%, and a forward price to earnings ratio on that pro forma company of 5.8 times. That valuation is quite low. It's still getting involved at $7 in LKSD shares or $11.20 Quad equivalent. You're still, I think, getting a really bargain price for pro forma Quad. So I think whether Quad's valuation goes lower at this point, and let's say you lose on the merger arbitrage, post-transaction, you're still owning a business at a very compelling price, in my view. So, let's just fast forward a little bit into the future. If, say, it is the print industry, let's say the print industry continues to structure decline, and what's offsetting that is that $135 million in net synergies that are anticipated to be realized over the next 2 years. And let's just hypothetically assume free cash flows remain relatively stable, then that implies, Quad post-transaction could, given how high the free cash flow yields are, could theoretically buy itself out in 3.4 years. I think post-transaction, you getting involved in owning Quad pro forma at $7 LKSD or $11.20 Quad, I think you're still buying a company at a bargain price. So ultimately, in summary, I think whatever scenario unfolds, I think the LKSD shareholder is going to walk away with a satisfactory result. Ultimately, I think it's like heads you win, tails you still win. That's my view, and I definitely recommend you guys, if you thought that this was interesting, I definitely recommend you guys dig on your own, do your own research, and take a look at the evidence yourself. So with that, if you thought this episode was interesting, or you learned something or saw something you hadn't recognized before, I'd really appreciate it if you hit the subscribe button, give us a like, leave us some comments for us. I do check all the comments and try to get back to everybody. And so just one other heads up, all this content is also available up on our podcast channel called Get That Bread Value Investing, so you can find us there as well. So with that, I'll see you guys on the next episode. All right, take care. Bye.